Good morning, everybody, and welcome to the September 2022 update, the Drilling and Production Outlook Workshop for Spears & Associates, and our outlook for the worldwide oil and gas industry. I'm John Spears.
I'm Richard Spears, and I'm delighted that we can actually be sitting in a room together.
Absolutely. Rich, why don't you tell the crowd what to expect for the next hour?
Okay. Well, first off, the Drilling and Production Outlook, or as we have called it for 40-something years, is the DPO. It's a subscription service that our firm provides to hundreds of energy-related corporations, the major oil companies, oil field service companies, financial institutions, the odd attorney here and there. But it's a subscription service, and you have already emailed to our clients the hundreds of pages and the thousands of data points. So you should already have it in your hands if you're a client, but this is our 1 hour presentation about the highlights of it.
Absolutely.
The other thing that we have the opportunity to do during this, this is not a podcast, during this broadcast, is that there's a comment section on on YouTube where if we're doing this live, you can send us the comments in the live chat section, and I'll be monitoring it off to the side, so that if you have a question live, I'll record it, and at the end of my brother's presentation, I'll step back in, because I'm not going to be in here during your presentation. I'll step back in and I'll pick them, and because we already have one,
sure, and
I'll present those to you.
Okay, great. So about 45 minutes for me, and then 15-20 minutes for Q&A on the back end. So
we're starting this at 9 o'clock Central Time on the 2nd of September. We'll be done by 10 o'clock Central Time the 2nd of September 2022. And but this will live on in infamy in the world of the internet forever. Anyway, we're going to take a 5-second break, move just to you.
Well, we're back again, and want to go through the slides again, like Richard said, to hit the highlights of the conclusions and forecasts, assumptions we've made in putting together our update this time around. As always, we start with a look at what's happening to, on a global basis, to oil supply and demand. If we just look at the news flow that's been coming across our desk in the last 3 months, there's obviously been a great deal of concern about the effect of recession, what might happen to global oil demand. Will it slow or begin to fall? And so on Mondays, Wednesdays, and Fridays, there are worries about demand, and prices seem to go down when that happens. On Tuesdays, Thursdays, and over the weekend, there are worries that there's not enough supply in the world, and so the market will be tightening up, and so prices go up on those days. So we're back and forth between worries about recession and worries about supply availability. And so it's interesting to think then about what the outlook is over the next 18 months for demand, particularly in light of the fact that clearly the central banks of the world, the U.S. Fed, and so forth, are continue to be committed to try and raise interest rates in order to slow economic activity and fight inflation, bringing it down. So that's something they began 3 or 4 months ago, and that process remains in place. We think it will be a feature going forward. And so the issue is so when you look at what the current sort of consensus opinion about the U.S. economy anyway is that economic growth, real GDP growth this year will be around 1.5%. Last year, I believe it was 5.7%. So material slowdown underway this year. Still economic growth of 1.8% here in the U.S. next year. So even with these higher interest rates and a slowdown underway, nothing going into recession, at least not on a year-over-year basis. And so the forecasts you see before you in terms of global oil demand and supply, reflects that kind of estimate for future economic activity. And what we see there is that in the context of a market this year that's rising about 2%. We're getting around 99.4 million barrels a day of oil demand on a global basis. Next year, the forecast is for another 2% type growth, taking us to about 101.5 million barrels a day. So no real concerns yet. And it's interesting then to understand why this continued growth is expected, even though there are worries about recessions here in the U.S. and particularly in Europe, of course, given the struggles that they have dealing with the fallout from the Ukraine situation. The developed economies of the world, so North America, Europe, Japan, so forth, collectively these days account for about 45% of global oil consumption. Used to be that they were 70, 80%. Those numbers have come down for decade after decade. Today we stand with about 45% from the developed economies. The emerging markets led by China, India, but you get all of Africa, South America, and so forth, Middle East, that those countries collectively now account for the bulk of global oil consumption, 55%. So when you break down this forecast from the chart, what it shows is that the developed economies will grow, their oil consumption will grow less than 500,000 barrels a day next year. They'll go from 45.8 to 46.2. And all that growth is happening in the U.S. Europe is flat, Japan is down, and so forth. The rest of the world collectively will grow about 3%, which is interesting because over the past 25 years or so now, the emerging market sector of the emerging country sector of the market has been growing at a compounded rate of about 3% year over year for the better part of 25 years now. In fact, there's been no recession in oil consumption among these emerging market countries for that whole period of time, except for the pandemic year of 2020. So everybody saw oil consumption fall in 2020. But that was the first and only time in the past quarter century that we've seen these emerging markets slow down. And that even accounts for the 2008, 2009 slowdown associated with financial crisis in the U.S. and back in 2011-12 for Europe's financial problems and so forth. So the expectation is that these emerging markets will continue to grow, and it's not really a function strictly of economic activity. There's rising population, there's industrialization, there's urbanization, a lot of these factors driving the emerging markets to continue to grow their oil use. And that's why the broader lines for global oil consumption continue to tilt up and to the right, at least on a slight basis for next year. So the worries, as I see it, about recession negatively impacting global consumption, I think are a little overblown at the moment. We'll have to see if that all plays out. There are some wild cards. Clearly, the extent to which China continues to lock down its economy and really impairs its oil consumption, we think. And so there are those kind of things out there that we do need to monitor. It's not a given that there will be growth in the emerging market sector, but that's the important place to keep your eyes on, I think. The other part of the story, of course, is where is the supply growth going to come from? And again, you can see in red on the chart, it's growing as well, but the elements of it are shifting. So the non-OPEC piece this year, excluding Russia, we have to exclude Russia. The non-OPEC piece is growing a little over 2 million barrels a day this year and is expected to grow a little over 2 million barrels a day next year. And the U.S. is supplying 65% of that incremental growth in non-OPEC production this year and next. The OPEC countries as a group are collectively growing 2.3 million barrels a day production this year, but they're beginning to bump up in the capacity, and that's been pretty extensively reported, really leaving, the estimate is that really only Saudi Arabia and the United Arab Emirates have any significant capacity to grow production at this point, and even they are close to their capacity limits. So the OPEC piece is, the OPEC output is at this point expected to grow only 500,000 barrels a day, or about that much in 2023. And so that really speaks to the issue of how tight the market is. There's really not a swing producer, as I see it, anywhere out there at the moment. And with capacity to handle unexpected production loss from some other country. And so we think the market will remain fairly tight, and that will match the expected growth in oil consumption. The U.S. piece, as I said earlier, is beginning to grow. This year, we're seeing U.S. oil production of around 11.9 million barrels a day. We expect, based on the forecasts we've put together for rigs and wells, that production will continue to grow, and by the end of 2023, U.S. oil output will be almost back to where it was at its peak in the last days of 2019, the early days of 2020. So somewhere close to 13 million barrels a day of total production at the end of 2023. So the year-over-year averages from 2022 to 2023, around 12.75, 12.8 million barrels a day. That represents a growth of about 7% year over year. But when we look at it from a year-end to year-end basis, so the year-end of 2022 to the year-end of 2023, we think it'll be more like a 4.5 to maybe 5% growth rate in output over that period of time. So I think we're looking at a slowdown in the rate of growth in U.S. oil output. Again, a function of the deliberate intent of operators to sort of reach mid-single-digit kind of growth rates in their production numbers. And the capacity constraints that the industry is facing with regard to rigs and frac crews and everything else. So this is how we see the U.S. oil production figures. Given our estimate of where we think of the tightness in the marketplace and the continued slow growth in consumption, we expect to see oil prices remain elevated. So we've got an average price of around $95 a barrel for the second half of the remaining part of this year, and an average of 95 for all of next year. Now, recognizing that the trading range around that $95 average is probably on the low side $75, and on the high side $110 for WTI. If you want to translate that to Brent prices, these days you add about another $8 a barrel to the WTI price, and you'll get a notion of where Brent is going to trade. So we see this as the estimate, or our estimate of where we think spot prices will fall over the coming year. So again, the average for this year is going to be just shy of $100 a barrel, if I have made my estimates correctly. So we'll be down a little bit. Total revenue for companies based on the sale of oil, certainly if volume numbers are growing 5%, but prices indeed fall about 5%, we're going to see total revenues, at least from oil sales for oil companies, end up being fairly flat year over year based on this kind of an analysis. Gas production in the U.S., again, linked to the estimates we've made regarding drilling activity and completion activity and so forth. We see gas production in the U.S. Continuing to grow. It's up, or going to be up, around 4% this year, somewhere around 97.5 billion cubic feet a day for the year as a whole. And that number grows next year about another 4% to around 101.5, 101.6 BCF a day in 2023. I think the issue that we have to worry about on the gas side is not so much the capacity or the drilling of new wells and the capacity of those wells to come online, but rather the infrastructure issue associated with the market access for that gas. So for example, it's well known that back in Northeast, in the Marcellus play, that gas producers there really face pipeline takeaway constraints. The pipelines are built. There's not really much new capacity being added to the marketplace, so they're kind of just marching in place when it comes to their future gas production numbers up in that section of the country because of this infrastructure constraint. In the Permian Basin, you might remember that back in the days of 2018 or thereabouts, we ran into pipeline takeaway constraints for both liquids and gas in the Permian. That was back in the day, if you recall, when the Midland price for WTI was $20 to $25 a barrel less than the Houston Ship Channel price for WTI. And it was all because there weren't pipelines. And so you had to either put it on a rail car or put it in a truck and transport it that way at a very high cost per barrel. So when production fell in the early days of 2020, that opened up a lot of space on the pipelines in place at that point. And since then, there have been, on the gas side anyway, a few more pipelines added to the Permian market. So at the moment, there exists sufficient capacity to take away all the gas that's coming out of the Permian. But given the fact that Permian gas production numbers are growing close to 10% year over year, it doesn't take much to imagine that sometime in 2023 we might begin to see gas production in the Permian curtailed because of the lack of pipeline takeaway capacity. And these days, we all know that flaring gas is not nearly as straightforward a decision for operators to take as it was 2, 3, 4, 5 years ago. This both because operators themselves have ESG programs where they're trying to minimize their CO2 and methane emissions, but then you also have the regulatory authorities who are cracking down on gas flaring, even in places like Texas. So I think it bears mention that we need to pay close attention to the issue of pipeline takeaways, particularly gas pipeline out of the Permian Basin, and the adds that might come on stream over the next 12 to 18 months in that sector, because that has the capacity to not only impact the overall gas production figures that we're estimating for the U.S. as a whole, but also it backs into what kind of oil production we might see coming out of the Permian because of this issue of constraints on flaring. So infrastructure is once again something, as it was back in the days of 2018-19, it'll be something that I think we need to pay close attention to, because again, we're going back above our previous historic highs in terms of oil and gas production in the U.S. The other thing about the gas market, of course, that we recognize is that prices have shot up this year. They're more than double what they were last year, and there's two reasons for that. One is, of course, the strong demand in Europe for LNG cargoes as they're trying to restructure their gas delivery system to minimize their reliance upon Russian pipeline gas. And so their alternatives at this point tend to be either LNG cargoes, which they're buying in bulk volumes at high prices, and some additional pipeline deliveries that might come from North Africa or places in Central Asia. What that means here is that in the U.S., with LNG export growth being so strong this year, that our overall gas inventory numbers are at the low end of the scale. In fact, as it stands now, you can kind of look by eyeballing that chart, we might get to around 3,400 BCF of gas in storage in November, just prior to onset of winter. Last year, that figure was higher than 3,500 BCF, and the year before, as you can tell by the blue line in the chart, it was closer to 4,000 BCF. So we're noticeably below where the market has typically been for the last several years. And in fact, if we end up with around 3,400 BCF in gas storage in November, that will be the lowest point, that will be the lowest November peak since 2005, except for the year of 2018. So only one other time since 2005 will we be lower, or have we been lower, than this estimated peak we're looking at now. And so that's really supported natural gas prices here in the U.S., both the combination of both LNG exports and this low inventory level. So our look at the gas market suggests that average Henry Hub spot prices are going to be around $7.50 this year, roughly double what they were a year ago. But that next year it moderates, and we're down to around an average price of around $12.30 per million BTU. So I think what we expect to see, assuming normal weather around the world, particularly in Europe, that the European scramble for gas supplies will moderate a little bit, and that will help ease prices. At least that's our expectation. But Old Man Winter will ultimately tell us where the market's going to settle next year. So the other thing I think, as we then begin to translate, so these are estimates of commodity prices and so forth, and what that means for drilling activity, I think the other thing we have to be alert to is the behavior on the part of oil companies with regard to their CapEx decisions and their financial flows. So we track 27 publicly traded U.S. oil companies. We don't include the super majors like ExxonMobil or Chevron in that, but these are the Devons and EOGs and Chesapeakes and so forth of the world in this group that we look at. And so collectively, they're 35-40% of U.S. oil production. Pretty healthy snapshot of what that group is doing. This is kind of a busy chart. The green bars, or the light green bars, are our estimate. So the dark green bars are the actual CapEx figures of this group of 27 publicly traded companies. And the light green bars are our estimate of what those CapEx figures will be in the third and the fourth quarter of this year. So you can see, interestingly enough, to me anyway, that the CapEx numbers for Q1 and Q2 were basically the same, right around $13 billion for this group of companies. They have not begun to lift their capital spending budgets, even though oil prices are well above what they had been estimating. I think this group collectively estimated that oil prices in 2022 would average around $75 a barrel, and of course it's almost 100, right? What have they done with those extra dollars? Well, that's what the red bars or the pink shaded bars tell us. So red bars represent the amount of money that these operators have put toward debt retirement and stock buybacks. And as you can see, so far this year, the debt retirement stock buyback piece is about 4% higher than their CapEx flows, and significantly above what it was last year, right? And if you look back in 2020, it's off the charts in terms of the difference. And we think that this kind of ratio between debt retirement stock buybacks and CapEx will hold forth in the second half of this year as well. So and what's the interesting thing then is beyond the financial return to shareholders and the like, these oil companies have been able to lift their cash on the balance sheet by around $5 billion in the first 6 months of this year. So not only have they been more generous with regard to their financial returns, but they've also been able to improve their balance sheets significantly, deleverage their balance sheets significantly. And so that just speaks to the capital discipline on the part of operators. It speaks also something to the point that they will have the capacity to absorb, say, a downturn in oil prices. If we think total revenues will be about the same next year as what they are this year, then that is something that, from a balance sheet standpoint, from a capital spend standpoint, I think they'll be able to tolerate. We might see that those paybacks for debt retirement and stock dial back a little bit, if potentially, but I think operators will remain very disciplined on message with regard to capital spend, and so I think then the decision becomes for many of these companies is not then what will my cash flow look like and so forth. I think it really then becomes how much do we want to grow production in a market that has these worries about recession and so forth, and in light of our inventory of undrilled prospects, how fast do we want to begin to burn through that? And so that decision about how much they want to grow production, I think, will set the tone for rig activity and spending and so forth. Everything flows from the decision about production growth. So we think, again, that operators writ large will probably shoot for something like a mid-single-digit rate of gain, around 5%. And so the numbers that you see on this chart and what we'll see for frac activity and so forth reflect that estimate of what we believe operator intention to be, here in the U.S. anyway. This year, we're going to average around 720 active rigs, up a full 50% from where we were a year ago. Next year, we think the number grows another 10% to around 790 rigs. The other thing that's become apparent to us anyway is that rig count has begun to, the growth in rig activity here in the U.S. has begun to decelerate. So rigs were being added at the rate of around 20 to 25 a month for most of the past 2 years. But in July, that number fell to 17 or 18. In August, that rate of growth was only 8 or 9. And so there's real slowdown in the rate at which rigs are being added. And I think there's two reasons for that. One is something that we've highlighted in the past, which is we think you're getting close to the capacity for the kind of rigs that operators want to put out into the field. These super spec rigs, best suited for drilling horizontal wells, those kind of rigs are pretty much at full utilization at this point. So the rate at which you can put rigs and crews back to the field is just harder and harder, getting harder and harder to do. And I think that contributes to this slowdown. But I think the other thing too is, again, from the previous chart, how the capital spend figures were so flat from Q1 to Q2, and there haven't been announcements about raising the capital spend rate, at least by the publicly traded companies, which account for so much of activity. So I think we're running into a situation which we've called budget exhaustion. Many of these capital spend programs that operators have had for 2022, I think were based on the notion that oilfield inflation would run around 10% year over year. Well, in fact, it's running around 20% year over year based on the survey work that we do. So the dollars just aren't going as far as what had been intended in the early days, and since the bank account numbers aren't being bumped up to cover that shortfall, the only thing that can happen is for activity to begin to sort of put a brake on future growth. And I think we've begun to see that over the past several weeks, and we anticipate that to be the case through the balance of the year. So we've pulled down our Q3 and Q4 numbers, and that's how we get to an average of 720 rigs for the year. And we think then that will carry over into next year as well. Interestingly enough, at this 790 or so rig activity level, that's sufficient to support a 5% growth in oil and gas production. We've run through that exercise to see what this kind of rig and frac activity does on the production side. A key assumption estimate we've made there is that the initial productivity of new wells stays constant over the coming year. So there's a lot of sort of inside baseball when it comes to those kind of estimates, but in any case, we think these kind of activity levels support this type of mid-single-digit growth rate in oil and gas production. Well spuds, so these are new wells being started, directly associated with what's happening to rig activity. Well spuds this year were around 19,500 or so. We think that number will grow to close to 21,500 next year, so up about 10% in terms of well spuds. So around a 10% growth in terms of rig activity, and not surprising, a 10% growth in terms of spud activity. We turn our attention to the completion side because, again, that's that market is tending to move in a different fashion than drilling activity. It was much stronger than drilling last year. Its growth has not been as much as drilling this year. So what do we see happening for 2023? Well, 2022, we think, will end up being somewhere around 11,700, 11,800 frac jobs, up about 8%. Frac spread count, as we all know, has been growing, but again, it too has sort of flattened out. So we see year-end frac spread count now of around 290 or so spreads at the end of this year. And then next year, we think that frac activity will grow about 5%, and that frac spread count will end up averaging somewhere in this 290, 300 range for the year as a whole. So again, drilling activity goes up about 10% in terms of rigs and spuds. Frac activity goes up about 5%. So again, I think what might be happening is that operators will sort of flex their frac activity to reflect the direction of oil prices and whether those are strong, in which case let's get some frac work done, or if they weaken, maybe we'll dial back frac activity. The other interesting thing we can do based on the models we put together is to look at how much frac activity might fall, would have to fall in order to cease any growth in U.S. oil production. And it's surprising to me anyway, when we did the numbers, it only takes frac activity to fall about 10% from where it is today and then hold at that level. And if that's the case, so we're talking 260 or so frac crews, somewhere around 10 to 11,000 frac jobs. You get to those kind of levels, guess what? U.S. oil production and gas production stops growing. Anything below those levels of activity, you begin to see production begin to decline. So it's interesting, in a tight market, not only can OPEC and the big oil exporters begin to limit a price decline by dialing back their production. Here in the U.S., we can affect the same thing by dialing back our frac activity. And the sensitivity is about a 10% change to move from a 5% growth type production scenario to a 0% production growth scenario. So frac activity looks like that. Again, with drilling activity going up more than frac activity, our count of DUCs begins to recover. So it has fallen for much of the past 2 years. We think it's at its low point and will begin to inch back up a little bit as we get through the end of this year and on into 2023. Canada is an interesting market as well. It, of course, is closely linked to the U.S. in terms of producer behavior. Capacity issues on the service side and whatnot. The only issue there is seasonality, so they tend to front load their years. So I think for 2022, we've kind of missed some of the impact of these higher oil prices. We saw a Q1 in 2022 that wasn't fully reflective of a $100 oil price number. I think we'll begin to see something more like of an impact on rig activity in the fourth quarter of this year and the first quarter of next year. So that would, again, reflect $90 to $100 oil price estimates. So the Canadian numbers then we think look like this: 179 or so rigs on average this year, up about 40%. Again, remember we've had a 50% growth in U.S. rig activity. So something like a 40% growth in Canadian numbers this year. Next year, our forecast growth for Canada is up about 2%, just 183 rigs. We'll see how that all works out. 6,300 or so wells, about 63 million feet of hole drilled. So big swings in the seasonal numbers quarter to quarter, but a bias upward, if you want to say, on a year-over-year basis, continuing in the Canadian market as it again recovers. Again, Canada's got real opportunities to export more gas. There were any number of delegations that have come from Europe to Ottawa to talk about where can we sign up for Canadian LNG cargoes, and the answer is, we'd love to send them to you. You'll see them in 2025, and so that's the issue that the Canadians have, is this whole production infrastructure, pipelines on the gas side, LNG export facilities and whatnot, that is really limiting, I think, how much of an opportunity the Canadians have to grow their own output at this stage. So those are the numbers for North America, and as we all recognize, in the volatility and the cyclicality that the North American market tends to be much greater than what you see in the international sector, and that's why for the past couple of years North America has been the star in terms of year-over-year growth rates, and the international sector has lagged behind. But in 2023, I think the turtle begins to win the race, and so we see a higher rate of growth in the international market in 2023 than what we expect to see in the North American market. And part of it's just the fact that, again, logistics plays such an important role with regard to international activity that it just takes 9 to 12 months to begin to respond to higher prices and changes in market conditions. And so where we've seen improvement, but we haven't seen the full adoption of activity and spending that would reflect these $90, $100, $110 prices that we've seen. So, but 2023 will sort of continue the good work there. And so we think that following an 11% growth in rig activity in the international sector in 2022, we'll see something like a 13% growth next year, coming up on 900 active rigs, right at 9,000 new wells drilled, and close to 70 million feet of hole. And I'll have some numbers on the regional breakdowns in just a second, but that's our look at both land and offshore international activity together. Just looking at the offshore piece, which I know is so important to a lot of service companies and equipment manufacturers, again, internationally, we expect that international rig count will grow about 14% next year, averaging somewhere around 192 active rigs as per the Baker Hughes rig count, and so forth. So again, the growth rate has been steady as she goes. I guess that might be the way to say that, since the latter days of 2020, but certainly nowhere near yet the rates that we exited 2019 at. So, and I think the big thing there is that, again, many operators around the world, look at where they think global oil consumption will be going over the next decade. Since we, have to think in decade terms when you talk about offshore projects, given the exploration and the field development effort. So, where will demand be on a global basis 10 years from now, and how much oil and gas do I already have on the books in terms of proven reserves? And when they begin to go through those calculations, I think a lot of chemical companies are finding that, hey, we've already got enough reserves to sort of satisfy the expected demand growth that we think we'll see. And so we really don't need to get out there as actively as we might have been in the past when oil prices were high and try and find new discoveries. So this I think is a feature that will sort of inhibit a full recovery, as it were, in both offshore and to some extent on land in the international sector. So we've got that going. The other thing, too, is, of course, that many of the big super major players like Total, BP, Shell, and so forth are now devoting a significant part of their capital spending, a quarter, 30% or thereabouts, to renewables. So taking it out of the fossil fuel development, oil and gas field bucket, and putting it over into wind and solar and hydrogen and the like. And so that is another break, as it were, on the recovery going on in the international sector, where we see so many of these operators playing. So again, broken it down on a regional basis, Central and South America, this coming year we think will be up on the order of 10-11%, 181 active rigs. You can see the numbers here. So a growth in a lot of these markets for now, we think. Petrobras in Brazil, of course, is going to lead the way when it comes to dollars being spent. Even though it's, Petrobras has to walk a fine line with regard to its cash flow and its capital spending and the like. It's begun to pick up its investment this year. We think, or the estimates are, it's going to spend around $9 billion in the upstream sector. With pretty aggressive plans for developing the Campos Basin fields. Shell and Equinor are ones that have other development projects going on in Brazil, and so we're going to begin to see more sort of non-Petrobras names when it comes to the upstream sector of the Brazilian market, as some of these big players, big international players, begin to stick a toe or get into field development production numbers, significant production numbers from that country. Europe, an interesting market this year, one that suffered. So we include the Ukraine in our European count, and of course, what with the conflict there, rig activity in Ukraine has fallen tremendously. So that's affected the overall numbers for 2022. But as we look forward to 2023, we think about a 4% growth in Europe. The offshore North Sea business is poised for a little bit of growth, although European governments have begun to talk much more in recent weeks about windfall profits taxes on oil and gas companies in order to generate cash that helps relieve some of the pain that their customers are feeling from higher energy costs. And so that will be something that oil companies have to balance with regard to how much money they want to spend when it comes time to invest in new fields. So perhaps the high hopes that folks were having about a recovery in the North Sea market were a little optimistic, because given the early days and $120 oil prices, because while it's well suited to supply the energy needs of Europe, it is a fact that European countries continue to insist on energy transition, so moving away from the use of oil and gas, and so they're struggling this year and next as they replumb their energy markets to deal with the loss of the Russian supplies. But I think longer term, energy transition, renewables are still firmly in the driver's seat with regard to Europe, and so the North Sea sector I think is going to have a challenge to sort of fit into that and grow from where they are today. Africa up about 12% as we see it, close to 1,000 rigs, 130 or so rigs, 1,000 wells, 130 or so rigs. It's interesting because of Europe's intent on finding non-Russian gas supplies. Africa sits very well. There's already pipelines that go across the Med. There's LNG projects exporting from North African countries and now even West African countries to Europe, and there's so there've been a lot of discussion at the country level, at the company level, about securing new gas supplies for Europe from African sources. And so that's why when they put together some aggregate numbers, it looks like there's a potential to lift Africa's gas output by around 30% by the end of this decade and almost double it by the year 2040. So something to keep an eye on there as the world, and Europe in particular, needs substantial amounts of gas going forward, and will continue to need substantial amounts of gas going forward. Mideast takes the cake this year, or the coming year. We think it'll be up around 20%. There are pretty aggressive programs now being put forward, both in Saudi Arabia and the Arab Emirates, about growing production. Aramco has said that it wants now to lift its output to around 13 million barrels a day of capacity. It's around 12 million barrels a day now, and it's going to take 5 years to get there, but we're seeing plans now and tenders put forward that suggest that that a substantial pickup in activity can occur over the next 12 to 18 months. So that's behind our major uptake when it comes to outlook for the Mideast market. And again, concentrated primarily in Saudi Arabia and in the Emirates. It's not spread evenly across all the countries in the Middle East at this point. And then Asia Pacific, up about 7%, close to the rate of growth I think it's had this past year. There's any number of countries there that are in play. A lot of major oil companies have been selling their assets in Asia Pacific as they rationalize the assets they own, trying to sort of high grade them both from a cost and from a CO2 footprint standpoint. And unfortunately, a lot of the new gas supplies from countries in Asia Pacific tend to have a high CO2 content. So that's a real problem when it comes to field development and the like there. So it's a bit of a restriction on how aggressive operators are being about field development. It takes more planning and certainly more dollars to get all that done. And then finally, wrapping up, we do take a look at China, Russia, and Central Asia. China, we think, will be down a little bit in the coming year. It's pretty obscure or opaque to try and get a read on the Chinese market, but we think it might be down slightly in the coming year, just largely because of a drop in revenues. From Russia, of course, interestingly enough, Russia has seen almost no decline in its oil production this year, even despite all the sanctions and so forth. It's redirecting its oil flows toward China and India and the Middle East. The Middle East is now importing Russian oil to burn in its power plants so that it can export more oil to markets abroad. So Russia's oil production is pretty steady this year, but is expected to fall about 15% next year as the full effect of sanctions begins to take hold. And if that's the case, then we think drilling activity is going to fall around 10%. And finally, in Central Asia, Kazakhstan, Azerbaijan, for the most part, Turkmenistan, and so forth, all the stands, down about 2% next year. The issue there is one of pipeline takeaway. Gas pipelines mostly going to China, some to Europe, big oil pipelines flowing to Europe. The issue for new field development then becomes how can the Caspian Pipeline Consortium expand its throughput capacity? It plans to do so, or will they need to find alternative routes, because the CPC actually picks up Russian oil, and depending upon the sanctions on Russian oil, that might impact how much flow one can get from Kazakhstan and so forth through the CPC. So there is this issue of maybe needing to build more new pipelines to handle new field development, and that will impact any field development plans that we see in the Central Asian market. And with that, I will cease talking and be happy to answer. See what folks are talking about.
We got maybe a record amount of really good questions.
Oh boy! All right.
So
folks are
apparently people are come out of COVID. They're trying to actually run businesses again, and
good news.
And because I was busy writing stuff down,
Yes.
I didn't see every one of your charts.
Oh, okay.
So some of these may have been answered.
Oh, gotcha. Okay.
But I'll ask them anyway.
Ask and answer. That's right.
All right. So you talked about offshore increase in drilling activity.
Yes.
One question was, what percent of the offshore drilling increase is associated with exploration?
Ooh. Yeah, so the guys on the offshore geophysical companies think they are seeing some bluebirds that indicate growth in that market. The problem is this, that there's almost no capacity. I think the number of vessels that can pull streamers has fallen by 75% over the past 60% of the past 3 years, and many of the ones that are, still marketed are dry docked. I mean, they've been cannibalized, right? So it's really tough if to say the first thing you want to do to explore offshore is go collect a bunch of seismic data, because it's like, well, that's going to take some time, right? So I think most of the increase that we expect to see this year is going to be on the field development side, except for places like that we know, maybe Guyana, Suriname. There's a handful of those kind of countries where there's a pretty significant exploration program going on. So, but I mean, and when you talk about then those countries, you're talking 3-4 rigs, above what we're exploratory rigs above what's going on.
So back in the olden days, when you saw an offshore drilling rig working,
right,
there was greater than 50-50 chance that rig was actually drilling an exploration hole.
Half the wells being drilled internationally were typically, exploratory holes.
But if you look at it then today, if you've got a rig running, there's a far higher likelihood that it's going actually after a commercial, it's developing a commercial field.
Yeah, there's that fine line between an exploratory well and an appraisal well, right? And so I think we get a lot of the appraisal well type drilling going on in the exploratory category, whereas before we had a lot of rank wildcats. So I would guess that E&A drilling has fallen 50% from where it was 5 years ago. Yeah.
There was an article maybe 15 years ago in the Wall Street Journal, which talked about this guy who was the drilling manager on it. I think it was an Amoco related rig, a rig that Amoco had hired. And it was essentially a critical article that says, here's a guy who's never drilled a commercial well. But they missed the fact that he was in charge of exploration. And I thought, oh, come on. It was critical. He's never drilled a commercial well, and he's still got a job.
Technical success.
Yeah, but I'm going, they
Gotcha.
just missed the fact that you're never going to produce out of an exploration well.
Yeah, gotcha.
Here's one. What about North and West Africa supplying Europe with natural gas?
Yeah, so that's been a big thing, and we've seen any number of discussions in Algeria with Sonatrach and the Italians, I think, and Egypt, and I mean all the offshore activity in the Mediterranean right now taking place around Cyprus, Israel, Egypt, and so forth. Even some projects offshore Libya are all really targeting gas to Europe. The problem is that again, you just can't wave a wand and start sending them more.
These are 10-year projects.
Yeah, they do tend to take a long time. So maybe some of the stuff in a place like Algeria can go a little faster than that, but here's a problem there. Some of the pipelines go through Morocco, and Morocco doesn't like Algeria. They got big political disputes. So there's those kind of constraints that have to be resolved. But I think that the Europeans have looked first to North Africa and then to Central Asia for pipeline supplies, certainly.
Well, it is right there.
It is right there, and there are pipelines, and so, do what you can, right?
Here's one.
Yeah.
You talked about there being no swing producer anymore. But the question was, what about Iran? And Iran as an indication that we the world have the right to put sanctions on a country, whether it's a right or not, I don't know.
Yeah, right.
But we put sanctions on a country, and then a country that can open up Iran as a producer of oil. Would that fall in the category of a swing producer, or is it just an incremental supply that is either on or off?
Yeah. So it can. A swing producer has no constraints on its decisions, right? It can go up, it can go down, and the market takes it accordingly. Iran is a different case because it's got these external sanctions. I think Iran currently exports in the order of around 700,000 to 800,000 barrels a day. So it's not a full hard 0 barrel sanction. There's stuff that goes in.
Trucks.
Yeah. Were sanctions removed, that number could probably double, maybe go up to 1 million barrels a day. So there's that capacity based on sanctions removal for more oil from Iran. What I thought was interesting was Saudi's comment the other day that said based on market conditions, it might factor back production, and part of that was, I'm sure, sort of thinking about, well, if there's a recession, what might we do? But it also could be a strategic decision about, well, we're not going to give up oil prices and allow Iran back in the marketplace. We might get production to sustain a price or hit a certain price level. So.
Those are so far beyond our ability to predict, aren't they?
Yeah, well, that's a G15 level kind of discussion, I suppose.
Should get Pierre Trudeau.
Well, I mean, there's a whole host of things. There was, early this year, and back in March, we were writing about, well, maybe the decision with regard to Iran sanctions is imminent, and then Ukraine happened, and it was the Russians who presumably had been on Iran's side now begin to put in restrictions, and that sent everybody back to the blackboard. So there's a lot of hoops. Yeah.
Here's one. What is the effect of the drought in both Europe and in China on North American energy? The idea being, here you've got what is it in Norway, where so much of their power is generated by hydroelectric.
Hydroelectric, yeah.
And then you've also got shipping down the Rhine and other rivers where, well, good luck with that if the river doesn't have enough water in it. So does the droughts that are in China and Europe now, whether they're long-term or not, we're not going to debate that, does it actually have an effect, positive or negative, on the U.S. market?
Well, I think short term, it's a negative effect, right? Because it slows economic activity and runs the risk of, recession, right? So then that backs into oil and gas demand, lower prices, and that I think is the short term effect there, right?
Long term, the drought goes away.
Long term, the drought, would go away. Does it open up a new market of sorts for the U.S.? I'm not sure it does, really. I think to the extent that either China or Europe decides that they need more energy supplies because hydropower issues, because they're not getting wind and whatever, they'll probably turn to closer sources. So for China, that would be like Australia. For Europe, it would probably be Africa.
Maybe the bigger issue than drought. Drought's it can always be a short-term event.
Yes.
The population growth of the planet.
Yes.
Is I wouldn't call it a long-term effect. I call it actually a medium-term effect.
Yeah, so for those of you data nerds out there, the UN came out with its biennial population
every other year?
happens every other year in July. So they updated their population forecast. They have a high, medium, and low case. The medium case, so we're at 8.8 billion people here right now. Their medium case takes that number up to 10.6 billion people in 40 years' time, and then flatlines it. The high case takes population growth to 14 billion people by the end of the century. Low case.
How many people would be living in my house at that
yeah,
point?
boy, oh boy, that's true. And what would you be charging them for rent? Yeah. So the low case is began to see population flatten out by 2050 and then decline. It gets down to 7 billion people or something like that by the end of the century. So it's just a fascinating exercise to go through. There's a lot of variables around fertility rates and cohorts and all this kind of stuff. But I think, when I do my very simple, highest, shining example of Oklahoma public education, right? So when I do my estimates,
That's right, both of us.
I get to, by the middle part of 2030s or maybe 2040, we kind of can top out at population growth numbers about 10% higher than what we are now. So
And when I do, and again, I have the same education as you do, that's 15 years.
15 years-ish, 10% higher, so global oil consumption probably 10% higher. And then it begins that's kind of a peak level. So forget the whole energy transition, EV cars, the whole thing there. It's linking oil consumption to demographics. And there I think we could see a peak much sooner than people currently are expecting.
You've always seen a very high correlation between population growth and energy demand growth because it's GDP growth, if you will.
Per capita consumption of oil has stayed flat. Yeah, so it's all been driven by GDP growth. And what's fascinating about the population discussion is that every country is seeing lower birth rates, not just here and there. It's everywhere. Something like 60% of the world's population lives in countries that have sub-replacement rate fertility
and
levels.
the replacement number is 2.1 kids per couple.
Per couple, yeah. I know. So
Whatever the term of
Couple.
define couple anymore. But
Okay.
yeah, the China number is like 1.2.
Oh yeah, right. Yeah.
The U.S. number is 1.6.
This past year, yeah.
Yeah, so far below the whole 2.1.
Now, there's fascinating discussion about growth can still occur in a country if there's immigration, right? And so you think about those kind of issues.
Yeah, but what about the country where the immigration guy left?
Oh, no, I understand.
It's declining.
Yeah,
So,
right.
it's about the whole thing.
Yeah.
All right, I was not paying attention enough to know. You have an oil company CapEx slide.
Yes. Mm-hmm.
Did you also show our oil field service company CapEx
No,
slide?
I haven't. And what's fascinating there is that, again, the amount being spent for CapEx by oilfield service companies in the first half of this year and the amount which they're returning to shareholders or retiring debt, again, both those bars are about the same height for the first half of the year. So they're doing just like oil companies are. The numbers bars aren't as tall. But that's what's going on. But the difference is that while oil companies, while doing that, have been able to build up cash on their balance sheets, oil service companies have continued to see cash on balance sheets come down. So I think this speaks to the real constraint on the part of service companies in terms of adding capacity. So they may not have problems necessarily tapping bank debt like they might have had in the past or some other things.
Oh no,
but
it's still a problem.
Yeah, but you think about a bank, it's kind of comfortable assessing a loan based on asset value. So it can be done, but still the oil company has to be comfortable with parting with the precious dollars that it has in its bank account, and there were fewer of those precious dollars as of June 30 than there were December 31.
And you said oil company, but
these are
oil
oil service companies. Yeah. So they're getting there. Yeah.
So that leads to the last question I'm going to ask, which was actually when the first question posed, and that is when you listened to the Q2 and really Q1 earnings calls of those companies who are in the North American hydraulic fracturing services business.
Yes.
You heard them say, essentially, we have no plans to add capacity for the balance of the year.
Yes.
One or two frac spreads here and there.
Yep.
But for the most part, the answer was we have no plans to add capacity, partly based upon our conversations with our customers, but primarily based upon what you just said.
Yep.
To stand up a frac spread that's been idle now for 4 years is going to cost me $20 to $30 million. To do that, I've got to have both the cash and the confidence that that frac spread's going to be available. And then you add the other factor, which is, and I've got to hire 50 people.
Well, there's a third factor
And
too,
keep 'em.
which is like some of those components, the engines and so forth, are 12 months out or longer, perhaps. So, I mean, there's just a real timing issue to get all that done. So I can see why over the near term and for the balance of this year, for sure, there's just not much increase in capacity.
So
out there.
the actual question then that was asked was, so that's what we heard on the earnings calls. Is that what we actually are seeing in the field? And, there's both David Hutchison and David Ott, who are in our firms. They spend a lot of time talking to people. We have Missy Parker, who's spending her time digging through every scrap of data that she can find. I'm on the road all the time. You and I spend all sorts of time with the major oil companies, major oil field service companies. And I think we can confirm that there aren't a measurable or a meaningful number of additional pieces of frac.
Yeah, right.
Cap
Hey, who are those guys driving down the road?
That's right. Now, what you do see is, there were, a million horsepower of BJ's old fleet that were on the market, and Basics fleet went on the market, and Pumpco's fleet went on the market, and people bought them. And so there are those frac spreads working that are kind of in the margins. Those companies that bought these 20-year-old trucks, repainted them, maybe didn't repaint them, just put a different magnetic sign on them, and are willing to do and happy to do these daylight one-stage frac jobs.
Yeah, so there's a stealth capacity element
it's
to the
always
marketplace.
existed. You still got to frac a vertical well.
But I don't think it's enough to materially impact activity counts or production growth or those kind of things.
It does not move the needle, because to stand up a frac spread now, especially if it's an E-frac spread, that's a $60 million exercise. If you could buy the engines for a new frac spread that were diesel, Tier 4 DGB, it's $50 million. So that capital does not exist, and so it's not going to be there.
Well, again, my larger point would be that there may not be demand for it. If oil companies really only want to grow production 5% next year, then they can do it with what they got. So why? And that's the crux of the matter when it comes to the service companies, the frac service companies, is like, well, in a market where demand for equipment is apparently fairly static, how much do I need to spend? It'll always happen, but it won't be anything that changes a lot anytime soon, I think.
Later on today, we're going to be reinitiating our podcast.
Yes.
The drill down. We haven't had one for a while. And if you listen to the upcoming drill down, you'll hear why.
Yes. Please do.
And as soon as I figure out what it is, we'll say what it is.
So,
I forget where I was going with that. But the point is, in a market that is static, there's no, growth is limited. So, but it's very profitable. The businesses tend to be very profitable, and it's during times like this the consolidation of the industry really ramps up.
Yeah, so there will be a lot going on from an activity standpoint. It will not be as frenetic, perhaps, as the kind of growth we've seen most recently. But there are still needs to be a lot of work done in order to make the industry whole, both on the operator side and on the service side. And I think that's what we'll hear more about and what a lot of 2023 will be about. So we'll post this, and it'll be up for folks to see. So put the word out if folks, that you know people that weren't online today, Happy to answer any questions that folks have between now and when our next session update will come out in December. Until then, best of luck to everybody. Thank you very much for joining us.